Risk management is a critical principle in trading. It is often overlooked by novice traders. Limiting risk is fundamental for long-term success. Effective risk management protects capital. Understanding risk is key to sustainable trading strategies. The math of Ruin demonstrates how risk percentage per trade impacts account longevity. High-risk percentages accelerate account depletion due to variance. Natural variance includes inevitable losing streaks in trading. Even with an edge, high risk can lead to ruin due to statistical probabilities. This example illustrates risk management with a $10,000 trading account. The trader employs a 5% risk per trade, equating to $500 per trade. A sequence of 5 consecutive losing trades occurs. Each losing trade results in a $500 loss, totaling $2,500 in losses. The account balance is reduced to $7,500 after the series of losses. Recovering from a significant financial loss requires a proportionally larger return. This is due to the reduced base amount on which the recovery percentage is calculated. For example, consider an initial investment of $10,000. A 25% loss would reduce the investment to $7,500. To recover to the original $10,000, a return greater than 25% is needed. In this case, a 33% gain on $7,500 is required to reach $10,000, illustrating the challenge of recouping losses. This example contrasts risk management strategies in trading. It focuses on the impact of different risk percentages on a $10,000 trading account. With a 1% risk per trade, $100, a string of 5 losses results in a $500 total loss. The account balance decreases to $9,500 after these losses. This illustrates the effect of consistent risk management on capital preservation. The key is to control potential losses to maintain a viable trading account. A 1% risk indicates a relatively conservative investment strategy. Recovering from a small loss is easier than recovering from a substantial one. Only a 5.26% return is needed to recover $10,000 after a minor loss. Smaller losses are more manageable and require less aggressive returns for recovery. Large, at-risk positions can trigger intense psychological responses. These responses often manifest as heightened fear and greed. Fear arises from the potential for significant losses. Greed is fueled by the possibility of substantial gains. The interplay of fear and greed can lead to emotionally driven decision-making, potentially compromising rational analysis. Emotional trading decisions often lead to deviations from a well-defined trading plan. One common mistake is prematurely selling winning positions, limiting potential profits. Another pitfall is holding on to losing positions for too long, hoping for a market reversal. These emotionally driven actions can undermine the effectiveness of a carefully constructed trading strategy. Significant trading losses can create substantial psychological pressure on traders. This pressure often manifests as a strong desire to quickly recover the lost funds. The urgency to make it back fast can lead to impulsive decision-making. Impulsive trades are typically characterized by lower quality analysis and increased risk. This cycle of loss and impulsive trading can exacerbate financial difficulties. The death spiral in trading refers to a destructive pattern of increasing risk-taking after losses. Traders experiencing losses may attempt to recover them by engaging in increasingly risky trades. This behavior often leads to further depletion of the trading account. The cycle continues as larger losses prompt even riskier strategies, accelerating the downward spiral. Significant trading losses can severely undermine a trader's confidence. Eroded confidence impairs the ability to objectively assess market signals. This can lead to hesitation or avoidance in executing valid trading strategies. The lack of disciplined execution further reinforces negative performance cycles. Position sizing is a crucial aspect of risk management in trading. The formula for position sizing is position size equals account risk per trade divided by trade risk. Account risk per trade represents the amount of capital you're willing to risk on a single trade. Trade risk is measured in pips, points, or percentage, depending on the asset. This formula helps determine the appropriate number of units to trade. Proper position sizing helps to control risk and protect trading capital. Consider an account with a $20,000 valuation. The trader decides to risk 1% of the account on a single trade, which equates to $200. The trader purchases stock ABC at $50 per share. A stop-loss order is placed at $48, limiting the risk to $2 per share. The number of shares to purchase is determined by dividing the total risk, $200, by the risk per share, $2, resulting in 100 shares. The share calculation is designed to limit potential losses to a predetermined percentage of the trading account. In this example, the trader is willing to risk $200, which represents 1% of their total account. With a stop-loss order set at $2 below the purchase price, from $50 to $48, the calculation determines the maximum number of shares to buy. The calculation: $200 risk amount divided by $2 risk per share equals 100 shares, ensuring the loss remains at $200 if the stop-loss is triggered. The all-in mentality in trading often stems from underlying issues. Insufficient capital can drive traders to take excessive risks. Trading with an account too small for the market's volatility is a contributing factor. These factors can lead to desperate attempts to recoup losses quickly. Insufficient capital can hinder financial goals. The primary solution is to increase savings, not to take on excessive risk. Savings accounts are designed to accumulate funds securely over time. Consistent savings habits contribute to long-term financial stability. Avoid high-risk investments when the goal is capital accumulation. Prioritize steady growth through savings for a reliable financial future. Overconfidence can arise after a series of successful trades. This overconfidence often leads to increased risk-taking and deviation from established strategies. The market is inherently unpredictable and can quickly penalize overconfident behavior. It's crucial to maintain discipline and objectivity, regardless of recent wins. Regularly review and adjust strategies based on market analysis, not emotional highs. Humility and continuous learning are essential for long-term success in trading. Impatience and the desire for quick profits are detrimental in trading. Trading should be approached as a business, not a get-rich-quick scheme. A business mindset focuses on consistent returns over an extended period. Sustainable trading strategies prioritize long-term growth and risk management. A statistically proven strategy is essential for long-term success. The strategy must have a positive expectancy, indicating potential profitability. Without statistical backing, larger bets become akin to accelerated gambling. Relying on unproven strategies increases the risk of significant losses. Risk management is a strategic process focused on long-term organizational survival. It is not primarily aimed at limiting potential profits. Instead, it prioritizes identifying and mitigating threats to the organization's existence. Effective risk management ensures the company can sustain operations and profitability over time. The most successful traders are distinguished by their ability to manage losses effectively. Loss management, not the size of wins, is the defining characteristic of top traders. Prioritizing loss management is crucial for achieving long-term success in trading. Consistent profitability over time is more important than occasional large gains. Longevity in the market is a testament to a trader's skill in mitigating risks. Effective risk management is crucial for long-term success in trading. Limiting risk to 1 to 2% per trade protects trading capital. Small risk percentages allow traders to withstand inevitable losing streaks. Preserving capital ensures traders can remain active long enough for profitable opportunities. Consistent application of a trading edge over time leads to overall profitability. Effective risk management is crucial for traders to withstand consecutive losses. The goal is to avoid being forced out of the game due to insufficient capital. Proper risk management allows traders to endure strings of 10, 15, or even 20 losses. This resilience is achieved by carefully controlling position sizes and stop-loss orders. By managing risk effectively, traders can stay in the game and capitalize on future opportunities. Resilience is a critical attribute that distinguishes professional traders. It separates them from those who approach trading as a form of gambling. Professional traders view losses as temporary setbacks, not as indicators of failure. They maintain a long-term perspective, focusing on consistent performance over time. This consistency, driven by resilience, is essential for sustainable success in trading. Trading success relies on consistent performance over time, not quick wins. It is a marathon requiring endurance and strategic planning. Discipline in position sizing is a critical factor for long-term profitability. Effective position sizing manages risk and protects capital. Avoid the temptation to chase large, unsustainable gains.